All right, guys, we're back again with another great episode of PFREI. I'm your host, Fuquan Bilal. Today we have a guest that's here for the second time, Martin Sines from BQuest Funds. So we had Martin on the show before, and early on when we first started the podcast, I think Martin was maybe one of the first of five, or maybe the first 10 people that I've interviewed. That's when we were doing in-person interviews. So we were actually at the Node Expo event, and we had the podcast. Everything was great. And if you guys want to catch that podcast, make sure you go back and you find the one where Martin spoke and gave his background story. Today, I asked him on the show because we're going to take a deeper dive, really. The theme of the podcast, is, why are you passionate for real estate? And in my conversations with Martin, basically it's transition now to what he's doing as he spoke to me, more of a service base. So I want to start off first, Martin, with the same theme, the same question. What are you passionate about today in your business?
Yeah. So I'm passionate about service to others. That's how I view success. And it used to be dollars and cents, and now it's just about how many people can I affect in a positive way.
Hmm, that's awesome. And then how are some of the service that you're providing? Like, what are you like? How are you servicing others?
Yeah. So
How are you
I
serving
started.
others? Actually,
I'm sorry.
I'm thinking of notes. I'm saying servicer. How are you serving
Yeah,
others?
I know servicer. Yeah, so I came into the real estate space as a small business owner that was accumulating properties. So I kind of saw service from a landlord tenant perspective, and providing housing for individuals. And I felt like that was really rewarding. And as I got more specifically into the note industry and working with homeowners that had some type of occurrence in their life that prevented them from being able to make their monthly payments, and just being able to engage with them and find out what they're able to afford now so that they can avoid foreclosure and help them get back on their feet with payment plans. And just having done that, you know, over 1,000 times personally, it's a rewarding experience knowing that it's had a positive effect. And just also too, I have a few books out there I've written, a few online courses, and these things help other aspiring entrepreneurs step up and learn our industry so that they can also too be of service to other people around.
Yeah, there's a lot of great points you mentioned. Actually, I can resonate with that for sure. I mean, it definitely gives me my fill of importance. The same things that you mentioned about giving homeowners a reprieve, right? And that is why I love the note business, and that's what really made me gravitate towards it and love it because from a laptop cell phone, you can change people's lives, right? You can share your discount when you buy these assets, and you get it at a discount. You can pass it along to the person and give your exit through the bar, whether it's a modification, whether it's a discounted payoff, or whatever that is. So I feel you on that. That gives me my full of importance. It's good to be able to do that because a lot of the institutional banks, not saying they're the bad guys, but they're not built for loss mitigation. So the way they go about it is kind of like not fair to some of the debtors, right? So we get the chance to come in and add the human aspect in it and change people's lives, like you said. So I appreciate you sharing that.
Yeah.
And the vehicle that you actually using to buy these notes, let's talk about that because I know you had a transition in your life where you invested first. You went over the hill and got the arrows in your back, so to speak. You built out your own personal portfolio, and then you started to actually go out and teach people how to do this to kind of create some camaraderie and some joint purchases and everything else. And that kind of led up to the fun that you have now. I guess you sort of writing on the wall was like, hey, I need to get this thing going. So let's talk about that transition a little bit and where you are today in the fund.
Yeah. So, I mean, from a training aspect, I started after launching the first book, Node Investing Made Easier. I had individuals that would be reaching out to me on a weekly basis. So it was kind of almost a logical fit that there's a need for other individuals that want to learn this industry, and they viewed me as a thought leader. So therefore, let me serve as a trainer, as a mentor. And I did that quite a bit for the first few years. However, over the past year or so, I've really kind of tapered that off, that part of the business. you know, it's given kind of how the climate is in the secondary mortgage market. I'm a lot more selective in terms of who I'm going to take under my wing to help develop. And so I'm training a lot less, probably about 90% less than what I was before. Also, to couple that with we're doing larger and larger trades as a company. So you know, my time constraints in place. And really, so what, from a training perspective, I want to make sure that, you know, someone is geared towards being able to commit and being able to put the work in and put their finances at risk to make this happen. I'm just not going to train, you know, otherwise, unless that's there.
Yeah, I'm smiling because I wrote a book called The Tire Kicker, and this is no pun intended to anyone listening, because I'm a tire kicker sometimes myself. We all
Yeah.
procrastinate, right?
Yeah.
So I wrote that book from my experience in the note business because I was like, wow, this is the best investment strategy in the universe. Like, why aren't these people taking this serious? Why are they continuing to show up to these events and in the same place? Why are they not going? So as a person that was serving the community and training as well, I had to make the same pivot in 2017 when I was like, you know what? Let me focus on the fun aspect. Let me focus on this, because that's a whole other business in itself, right? You got the note business and then you got the raising capital business. So I transitioned all of that. And I kind of saw when you made that pivot, I was like, okay, he's getting it. He understands it. That's where the focus, more time should be spent there to serve the investors, still help out the community, because you still want to have that give back. It's like a guilty feeling inside of us, right? That we have this knowledge. We want to pay it forward. We want to share, but we want to share with people who's actually going to take action.
Yeah.
So, you know, thanks for sharing that. I can relate with you, brother. 100%. I get it.
Yeah, because I mean, you know, it's the fruit of your labor as someone who's a mentor or coach, is to be able to see someone that you've imparted some knowledge to, and that they're using it to its best ability. And that tells you that they're going to have an effect on someone else at some point. They're going to be a mentor and coach to someone else, the next generation, so to speak. And that's how our world needs to work in terms of giving back. And so it's not to say that the tire kickers are you know, bad people, as you say. It's just that they may not be ready. And so this industry, as you know, with regulation, all the compliances, licensing, servicing, everything, it's very convoluted, complex, and you need to be really committed, fully immersed for it to work. So
Absolutely.
you know, someone
Yeah.
needs to know that coming in.
Yeah, it was a wild west when we got started, but now it's heavily regulated. So you really truly have to be selective, to make sure that people have the capital to be able to do what they need to do to survive in this business and play by the rules. So I get that. And the dovetail on what you said earlier, you know, the greatest feeling is when you mentor someone and then they go on to grow. And then you see them. Like, I had someone come up to me in one of the conferences, go, "Hey, I left my job. I'm full time into notes now, because
Yeah.
of the things that I've learned, you know, along the way." And I was like, that was such a rewarding feeling. It was better than, you know, getting $100,000 wire or something. It was like, wow, this is great. So I kind
At
of
least
resonate.
as good.
Yeah. So let's talk about the fund now a little bit. So
Yeah.
how does your fund operate? Like, what type of assets you buy? Are you buying
Mhm.
first, seconds? You know, let's dive into that a little
Yeah.
bit.
So the fund it's a 506c Reg D income fund, and it's set up for accredited investors. The minimum buy-in is 50,000. There's two options. Someone can go, they can be a Class B shareholder and earn an 8% annual pref paid monthly to the investor, and that has a 1 year commitment, or they could join with a Class C shareholder commitment, which is a 9% annual pref and a 4 year commitment, and that also too pays monthly. So there's kind of two ways to go into it. The thought behind BQuest is, you know, just the name BQuest is a legacy play, and by definition. And we set it up as an evergreen fund because we wanted this to be something we can grow, build out, pass down to our children beyond our time in this business, but also our investors can do the same. So I had a passion shift, if you will, over the past couple of years. And you know, my passion's always been for a small business owner. My heart always goes to small business owners, entrepreneurs that want something better than just a W-2 existence and want to kind of go out on their own and create something for themselves. And so I still have that in my roots. However, I've also morphed that into passive income and the need for the average families to grow passive income in their portfolio, in their lives, right, as in a whole, especially given inflation. So Bequest Funds is set up as an income fund because I do believe that the way we're headed as a country, passive income is more important than ever in today's world.
Yeah, great point. Now, are you the type of assets that you guys are buying? What do you have in the vehicle?
Yeah, so they're mostly junior lien mortgages.
Okay.
And we do have a few senior liens in there. And so they're all residential mortgages on owner occupied properties. And so, the key to the secret sauce for the fund is investment to value. So we keep, and we call this out in our PPM private placement memorandum. We keep our portfolio collectively under 65% investment to value. And currently we're sitting at 62% investment to value. So what that means is the sum of the senior lien balance along with what we paid for that junior lien note is not to exceed 65% of the value of the property. So then that way there's always a 35% equity coverage cushion for that investment. And that should give investors a sense of assurance from a capital preservation standpoint. And so that's really the heart of Bequest Funds from a capital preservation, along with never having missed a payment. And, so that kind of speaks to investors' confidence in receiving monthly income.
Awesome. Two last questions about the fund, and we'll move on. What is the fund target to raise? Because you said it was evergreen, but of course, once you hit your target fund, the next fund comes up. What's the target? And when did you launch the fund?
Yeah, absolutely. So the fund launched in March of 2020. And so it's a $50 million fund. We have 7 million assets under management today. Our goal this year is to raise $15 million and thereafter to close out the fund at a $50 million cap out at the end of year 3.
Awesome. Great,
So,
man.
so it's pretty aggressive from our perspective.
Well, there's a lot of capital out there. There's a lot of capital out there that is chasing yield and not really chasing deals that are realistic. So with all the capital that's out there, with the stock market and everything, I'm pretty sure that's not too aggressive. You have a goal, and as long as you make the deliverables, you set the deliverables to achieve those rocks, you'll be successful. I have a lot of faith in you, my friend.
Thank you, Fuquan. I know you're doing something very similar, so I'm sure that
Absolutely
the same goes to you.
Yep. So moving right along, also now to the market space. So again, I've had fix and flip guys, wholesale guys, multifamily guys, and when I first started the podcast, I interviewed the note guys because that was what was in my circle at that time to get interviews. And basically, we haven't really touched on the state of the note market right now. What are you seeing as a note investor? Like, I always get these questions, but I'd like to hear from you. Is it still an abundance of notes out there for you guys to buy at the price point you want to buy? And two, as far as borrower management, how has the whole COVID and the moratorium on foreclosures affected your business plan? We'll start with the first one first on the assets available in the marketplace.
Yeah, so yes and no. So I posted on Joe Roberts put a post to this effect. He was entertaining the same question about are there notes in the note space, and I had placed a comment that 2021 is the year that the note investor dies. And then I got all this kind of negative feedback, and I'm like, oh goodness. I'm like,
I love it.
Sometimes you just shut my mouth.
Clickbait.
And what I mean is that not that, a negative against an individual. It's that the mom and pop retail note investor is not going to make it, in my opinion, is not going to make it much past this year. And so I was at a real estate, I was at a RIA meeting this morning, real estate, Sarasota real estate meetup. And I met an individual, and he has been note investing since 1978. Jimmy Napier taught him. And so he's telling me the exact same thing that I had mentioned on the LinkedIn post. He's like, I can't find any deals. Now he's a contract for deed guy. He doesn't buy in bulk like our company buys in bulk and pools of mortgages. He buys one-offs here and there all around the country. The way compliance is going on, I mean, unless you have a full-time compliance team or person, a collateral person, a acquisition team that's effectively drumming up deal flow on a daily basis, and a whole asset management operation behind you to do the workout, it's extremely difficult to operate in this space. There's just not a lot of inventory because not a lot's trickling down from the larger hedge funds. Now, with that said, we have been busting at the seams in terms of takedowns. We all throughout COVID, we saw a lot less competition for larger size trades. So we were able to take down trades. We've had some buyers that were pulling out that were normally buying on the scene, and as a result, going into 2021. A majority of our trades are negotiated trades. So they never see the light of day. They don't hit the brokers and all of that. But what I'm seeing, even with the brokers that they may have like 20 buyers vying for assets on any given trade. There'll be 3 or 4 larger players that actually have the bandwidth. They can throw down the money, and they can do due diligence efficiently and as a one sole operation. And then the rest are going to be conglomerates, right? Several node investors teaming up, or single node investors that are just bidding on small carves and everything else. So you just really have this whole dichotomy, right, between the have and the have-nots within the node space. And I think that's only going to intensify as we go on, especially as a lot of this '08 paper, this '06 originated paper kind of filters out or kind of gets washed out in the industry.
Yeah, and the bigger companies have cheaper capital, right? So they yield threshold of expectation is lower than what someone else would expect, right? Most guys that play in the space would say, I need a double digit exit, need a double digit yield exit. And these guys are happy with, sub 10, 8, because they're raising money at 3, 4, or whatever it is, right? So it's more of like a preservation of capital play for them, where most people are trying to actually make it into a business and make a double digit yield. And it's
we're going for a line of credit now with a bank, and we're talking. We met yesterday. Sean and I, my partner and I, met yesterday with a CEO of a local bank. They have $2 billion in assets, and so we're going for a line of credit. And I said jokingly to him, because he said, hey, we're going through this whole PPP, and I said, hey, you don't want to take back one of those loans and have to hold it at 1%, do you? And he laughed and he said, we're paying 15 basis points for that money. We make money at 1%. And I was like, oh my goodness. I'm like, that's disgusting.
That's the bank business, right? You gotta love it. You never know. So on the other one, the other question, I don't know if you remember that I asked, that was for the marketplace. Do you remember the other question?
No.
Appreciate your honesty.
Yeah.
So one we were talking about the marketplace, the other one was bar management. How was that affecting the business with collections? Because people are gaming the system. I mean, I have it going on in my portfolio. People, it's COVID, or it's moratorium. So I mean, I've seen some delinquencies and some of the stuff that I've had. We had to jump on track and defer payments and do some creative stuff to get these people back on track. But how have you seen from when COVID hit, you're buying everything, to now, the transition in that,
Yeah. So on the positive side, we're seeing a major uptick in the amount of payoffs that are occurring in the industry. And I hear that from other folks in the industry. I'm sure that you kind of seen that too on your side. And so that's positive. People feel good about their homes. They're either going to refi it or sell their home to go cash out. And then as a result, you gets cashed out. On the negative side, there's moratoriums either on the foreclosure or eviction side, even though it's CARES Act related, and you may not be applicable with your paper because it's not government sponsored paper. It still affects you because you want to be in line with what the CARES Act mandating, and you want to be respectful of that. Legally you could get in trouble otherwise. So you just want to kind of walk that fine line. And there's a lot of homeowners that will, kind of use that to their advantage. And what I would say is that this is the strength of an internal asset management team that piggybacks off the loan servicers. So you can't just rely on the loan servicers loss mitt program, and you can't outsource asset management. You won't get the same results if you outsource, asset management. And so it's just really cultivating relationships with the borrowers and letting them know that, yeah, you may defer it or ask for forbearance, but this money is snowballing on you. And if you have the ability to pay it now, it's, in your best interest. We'll cut you the best deal. The earlier we can get to the table with the homeowner, all the same things that were pre-COVID kind of philosophies with asset management. We kind of, intensified the approach with the borrowers, but still keeping the humane aspect of asset management.
Awesome. Yeah, this was good, man. I appreciate you taking the time out. I know you're pretty busy down there in the Sarasota part down there. How is did you join the yacht club yet down there?
No, I'm living through Steve, and my partner's having a boat built right now. So Fuquan, I think I didn't realize I was cheap till later in life, but I don't really care about material things. I don't spend a lot of money. I wear like the same, type of clothes every single day. So I make no fashion statements. So I'm probably a pretty boring guy.
Yeah,
but,
I know it's a lot
provide
of
for my
your home base. Where I was going with that is I know you just made a transition from Washington from DC to Sarasota, and there's a lot where you're at. You're right on the water. There's a bunch of yacht clubs, a bunch of stuff like that. So I was just saying that you're getting the mix down there. Maybe you became a member, having some functions or whatever. But they just had a boat show down there, speedboat show or something down there too.
Yeah. We saw the boats down here, and that was really nice. And it's interesting when we made the decision to relocate, we relocated the whole company. So we paid people relocation bonuses to come down. We moved them. I moved my family. Sean moved his family from Denver, and so it was a whole major effort. And the thought process is obviously sunshine, tax savings, and to be surrounded by accredited investors. And we just thought, that we'd open the doors and all these accredited seniors they would come pouring out of their $2 million condos, lining up to give us capital.
Yeah.
And obviously, just by me telling you I went to a RIA this morning tells you that I'm doing the same tactic I was doing in DC.
Yeah, but you have to go out and press the flesh, and raising capital is a relationship business. People invest with who they know, like, and trust, and basically that takes time. So that's why I mentioned earlier, it's a whole separate business, right? You have to build that credibility, the track record, and everything else. But just keep doing what you're doing, making those payments on time, and being in the right places, and building that track record, and people will be lining up, and then it would be, I got to find more inventory. They have all three, be able to scale, have the resources where to purchase from, and the capital to buy. So that's what I've learned earlier on in the note business. But thanks for having you on the show, man. It's another great episode of PFREI, a passion for real estate investments. We have Mr. Sines here from Bequest Funds, and you guys go check them out. Mark, you want to give your website information where people could contact you if they're interested in learning more about what you do? Go ahead and plug that.
Sure. You can email us at info@bqfunds.com or visit us at bqfunds.com.
There you guys have it. Be sure to check us out on all social media platforms. Passion for Real Estate Investments for Quan Bilal. Signing out. Thanks for coming on the show, man. I appreciate it.
Thank you, Fuquan. Good seeing you again.